Cool. I think we're live. Appreciate everyone joining. I'm here with Isaac Hayes, the third CEO of Fanbase, and Kevin Morris, CEO and founder of Atlas Road. Two guys who are very experienced in the crowdfunding space, both on the issuer side as well as the consultant side. Just a brief disclaimer at the beginning. This webinar is purely for educational purposes. We're not promoting or highlighting any offerings or raises on StartEngine. But with that, I'll hand it over, maybe Isaac, to you first to introduce yourself, give a brief background, and then you, Kevin, and then we'll jump into some questions.
Yeah, I'm Isaac Hayes III. How you doing, everybody? Founder and CEO of Fanbase, and I have been in the equity crowdfunding space since 2020. I've learned a lot, grown a lot, and understand a lot. So glad to be here.
Cool, awesome. Hey guys, happy Thursday, Thursday morning. A little earlier here on the West Coast. My name is Kevin Morris. I'm CEO of Atlas Road. I've been in the crowdfunding space since 2017 or so. I actually started out as an issuer, so I was sort of on Isaac's side of things, CFO, sort of COO of a number of companies that successfully raised money through equity crowdfunding. Got tired of being a CFO about 3 years ago and switched roles. And so now I partner with founders and companies to help them navigate the equity crowdfunding process. Excited to be here.
Awesome. And I'm the director of fundraising at StartEngine, have been helping issuers raise through both Reg CF and Reg A plus for the last 4 years now. Both of you guys have obviously been in this space for a while. Would you mind telling everyone, how did you initially learn about crowdfunding or get introduced to the space? And Kevin, I'll let you go first, and then I'll go to you, Isaac.
Yeah, as luck would have it, my business partner at 2 companies ago, who actually since has become a client again, he read about the Jobs Act and was like, "Hey, we should explore this for our company." The company that I was a co-founder of, it was a consumer goods sort of apparel space, and he said, "Hey, we should try this. You know, we've raised some money privately, but we have this huge base of customers and emails. We should try and raise capital from our own customer base." And so I sort of fell into it that way, and haven't looked back ever since.
And myself, I was actually introduced to equity crowdfunding through a colleague of mine by the name of Dawn Dixon. She raised capital on StartEngine, and she was actually the first Black woman to raise $1 million in equity crowdfunding. So I became aware of that back in like 2018, 2019. And I started reading about the Jobs Act and understanding how it could really help with raising capital for my startup, which I started in 2018.
Great. We have a lot of founders listening to this webinar today, and I'm sure they're eager to hear some of the advice that you guys have and strategies you've used to raise capital successfully, both for your own companies as well as assisting other companies. But to maybe bring everyone up to sort of the current day, would like to get both of your comments on how have you seen the crowdfunding space evolve, especially in the last 3 to 4 years. We've seen incredibly volatile and uncertain private capital raising markets as well as public markets. So I'd be interested in both of your takes. And Isaac, I'll go to you first on how has crowdfunding evolved the last 3 to 4 years from an issuer and a capital raiser perspective?
I think it's become a lot more acceptable and respected. I think initially the way that equity crowdfunding presented itself is almost as a threat to traditional venture capital raise, because now you're giving companies the opportunity to raise capital from the general public, not necessarily angels and VCs. And so initially it was kind of frowned upon, almost looked as dangerous or unsafe. But I think over time, especially through COVID, and the amount of capital that people have been allowed to raise, I think it's opened up the idea that it's actually somewhat a little bit more risk averse, not risk free, but risk averse than just doing venture capital or even investing in the public markets that fluctuate. It just gives you an opportunity to get into some really good companies that you would have never had a chance to get into. You would have never heard about. You were almost not allowed to be a part of them. So I think it's a lot more accepted, and it's a better pathway for founders to raise capital for their companies, but also, if done correctly, maintain control and the direction through the growth process, which sometimes slips away when you start taking venture capital in those forms.
Kevin, what's your take?
Yeah, I mean, I think that's right. I think in the early days of crowdfunding, you had a lot of companies who probably not a lot. Some companies who were crowdfunding because they maybe couldn't raise money in sort of traditional means. And then there was certainly that reputation or sort of view from traditional investors that they look down on crowdfunding. It's, hey, you crowdfunded, we're not going to touch you. Why would you do that? It was sort of this ivory tower sort of mentality from VCs and everything. And then again, in the last few years, and the VC market has dried up a bit and changed, and VCs were asking for more rights, lower valuation to sort of get have a bigger stake in companies. You have a lot of founders who are turning to crowdfunding because one of the big things, obviously, there's a control issue, which Isaac mentioned, and giving up board seats and things like that. But I think there's the control issue in the sense of founders want to be more in control in the fundraising process. They want to be in the driver's seat. And everyone here or any founders pitched a VC or a private investor and hasn't heard back from them. They thought there was interest, and then it was sort of like, and then they didn't hear anything afterwards. And I think with crowdfunding, a founder can be in the driver's seat. They can control the process. They have much more, control over the actual live fundraise. And I think that's important. Founders want to get up and go. Like that's what founders do. Is they don't like to sit on their hands. They like to make decisions, and they want to move forward. And that's with their business, but that's also with the fundraising process. And I think a lot of founders are seeing that now. The other thing I'll say is I'm seeing a lot more companies, including some that I've worked with before, that have raised traditional money and then gone to crowdfunding after, which you didn't see that a lot. You'd see these companies get, be VC backed and then sort of, hope that firm or that institutional investor would just go ahead and back up the truck every time they needed more money. But now a lot of companies are raising from high net worths and from private, and from VCs, and now exploring crowdfunding. And I think, that's just great to see. And it's exciting for someone like myself who's been in the space for so long to see how it's evolved over time.
It's really interesting to see that evolution. And Kevin, I'll stay with you for a second. You and Isaac both talked about crowdfunding becoming much more widely accepted over the last few years, and it's viewed as a more valid form of raising capital now. A common question we get is, does raising through equity crowdfunding preclude me or make me unattractive to raising VC funding in the future? What's your sense of that?
I think everyone asks me that, and they say, well, what about if I have 1,000 people on my cap table? The VC is not going to like that. And I said, well, that's sort of there's some rules around that, but that's sort of a misnomer. I think the biggest thing that founders should worry about when they're crowdfunding is make sure you're not going out at too high a valuation. That will then, if you do want to raise money privately later, or want to pursue some sort of liquidity event, you're not too far out over your skis. And I think that's the biggest advice that I give my clients and people in the space is, if you are going out to the crowd, it's a different lens in terms of what the valuation is, what the class of stock is. Just make sure that you're reasonable with all that, because you're hopefully you're crowdfunding the rest of your life, but there's always a case where you go back and raise money privately or potentially pursue an IPO or get some sort of exit event. And so, it's important that you level set yourself on valuation, because you don't want to screw yourself down the line if you want to raise a large check from a VC, and then all of a sudden it's like, hey, I need to give you a haircut on your valuation, and all of a sudden you have some unhappy crowdfunding investors. I think that's the biggest thing that I've seen, and I've seen a lot of founders make that mistake, and so that's a big piece of advice that I like to share.
Isaac, I'll send that same question over to you. You really focused on using equity crowdfunding as your primary form of capital raising for Fanbase. How has that influenced conversations you've had over the years with institutional investors?
I think it's given me leverage. I come from the music business, and so I always looked at equity crowdfunding as being independent, like an artist. And I looked at the VCs as the labels. And so if you come in with no leverage, they can offer you any type of deal they want to offer you with any type of terms. But if you can show that you can raise capital without them effectively, it changes the way that they treat you. It changes the way that they look at you. It changes the way that they talk to you. And I think that's really important, because if you don't have leverage, you don't have anything at all. And so with coming into this space, I remember, the way that VCs kind of treated some of my colleagues in the way that it was very, very, we're the top dogs. We dictate and determine, who gets funded and who doesn't. But what I found interesting about that conversation was that the only qualification for someone to even be in that space, to be an accredited investor, was wealth. It was never intelligence. So it's not like you had to take a test to become an accredited investor. All you had to do is, have a net worth of $1 million minus your house and make over $200,000 a year. So it's interesting that venture capital might say that investors aren't savvy enough to make those types of investments, but the only qualification is wealth. And so when you remove that barrier where everybody doesn't have, $200,000 a year or a net worth of $1 million, it opens up the opportunity for people to raise capital directly from their community and really can actually fit directly into who believes in your product. So whatever you're raising for, you kind of have a built-in audience, a built-in group of investors that want to fund your business if they're familiar with your product or believe in your product or see your product and actually are able to use it and understand the potential that's there. I love it. So it's extremely disruptive. Equity crowdfunding in itself is a disruptor in tech, as it should be in other places. So I love it.
I was just gonna, if I may chime in, Isaac, that was a great example you gave about your if you've raised money from the crowd, whether you're B2C or B2 or B2B business. Obviously, the crowdfunding investors will, you're raising money, you put money in your balance sheet, so that's an asset there. But also, your crowdfunding investors are an asset for the business. They're loyal fans, and obviously, I oftentimes see if you raise multiple times, these investors will follow on. So there's obviously an asset there in terms of like your ability to go back to the well, and I mean that in a good way. But they're also your fans for they're your cheerleaders for the business. And again, whether you're B2C or B2B, they're out there, they're talking about you. I've seen also just a lot of examples of companies that are B2B and their crowdfunding investors and their marketing activities have had this huge halo effect on the business outside of just writing checks. And so I think that's really important. And yeah, the other point you said was like, it sort of gives you more confidence and leverage when you have these crowdfunding investors. And so, it's not necessarily cockiness if you're talking to VCs after you've crowdfunded, but it's like, you can go into these conversations and say, I don't necessarily need your money. I would like it because I need to grow my business, but like, I've been successful with the crowd. And again, I just think it gives you that sort of that confidence overall in your business when you're able to obviously have a group of people that you've raised capital from, but also understand your business and connect with your business. I think that's really important.
Can I add to that? Coming into equity crowdfunding, I learned more about my business going through the process of qualifying for a round than I would have if I would have gone through a VC. That process of compliance, I had to learn, even though I think every business should, it just forced me to learn about my finances, my cap table, my corporate structure, all of these things that you probably would not be armed with or trust someone else with if you didn't. So I think it was the best educational process for me because now you have a perspective on the terminology, the understanding of how the business works or how your business works. So when you're talking to a venture capital person, you understand the type of securities that you can offer, preferred stock, all these things that you probably wouldn't as just an ambitious founder that just wants to raise money, you might not pay attention to. And some of my friends who are very brilliant in tech often fail to actually learn that. And then they found out the hard way. And so I tell everybody, equity crowdfunding is a founder's boot camp to really learning other parts of your business that you probably would not know if you just went to a VC, got a check and kind of felt and let them kind of run things. So it's definitely gives you a better base of knowledge in understanding about how to run your business and how to navigate through having conversations with VCs.
I'd like to double click on the comment you both made about community building through crowdfunding. And Isaac, I'll go to you first because you built a really large community for Fanbase and also through your investors in Fanbase through your multiple crowdfunding raises. Can you talk about maybe for your first raise and then for subsequent rounds, what that organic community marketing strategy looked like? And then a point you and Kevin both mentioned, the ancillary benefits you gained from allowing that community, allowing those users to become investors?
Well, mine can be unique, but I'm not sure. I think some depends on where you are in the process. When I started with Fanbase, I bootstrapped the first MVP of the product. The reason why that is important is because if you're raising capital for a product, as much as you can bring to the public that they can see, touch, or understand before you ask for money, the better. It was a lot easier for me to raise money off an app that people could download from the App Store as opposed to PDFs on a page. And so I think that had an enormous effect on how I was able to market the raise, because people can assess the quality of the product themselves and then determine whether or not they felt that this was something that they wanted to invest in. Being that it was social media, then it's a community. So now you have a community of people that use your product. Just for me specifically, you have a community of people that are using your product that are also investors in that product. And there's pride there. It's like, we're here, we're part of this. We are the early adopters. We're on the ground floor. And in the space of social media and technology, it's pretty exciting to be in a space like that, where you are looking at a product that is trying to take on some giants. So for me, we didn't do traditional advertising, like running ads. A lot of times people say they run ads to actually bring in a certain amount of investment. In those early raises, it was all word of mouth and network and relationships. But I always felt proud, and I always say nothing speaks better for Fanbase than the product itself. I could tell you all day to invest in Fanbase, but I would first say go download the app, use it, and then determine whether or not you think it's a wise investment to do so. So for me, the more you can do on the front end to have a product that people can that's tangible, the better. Now I know some people aren't out there, and you might need to do an MVP, or you might need to just raise a little bit of capital just to get your MVP built. So you might need to raise just $200,000 to build that first product that you need to have, and do that. But then after that, it'll actually increase your chances of being able to raise more capital because people can actually use your product.
Kevin, you've helped both consumer-facing companies, more like Fanbase, as well as what I'd call more traditional B2B companies that don't necessarily have community baked in on paper. How do the marketing strategies for a crowdfunding campaign differ between those two different types of raises?
That's a great question, and if I can help answer that, I wish I had the crystal ball to be able to help every B2B sort of business raise through crowdfunding. So I think with the B2C side, you're inherently with Isaac or any company that's sort of very consumer facing, you probably have a decent sense or a good sense as to how to market the business or the product to the end consumer. I mean, that's what you do. Now, obviously, you have to fine tune that, but you launch your business knowing that you have to explain what you do to somebody on the street. With the B2B side, you don't, right? When you're marketing a piece of SaaS tech or medical device or whatever it is, you're used to explaining it to a potential business that would buy it, or a doctor, or whatever it is. And then when you're trying to pitch it and sell it to an investor, trying to get some capital from an institutional investor, private investor, you have the ability to sit in front of them and discuss it and have an hour call, meetings, Q&A, right? But with crowdfunding, you have to distill that idea down to very easy to understand sentences, imagery, things like that. And I think oftentimes you have companies that have a great business or product, but aren't necessarily set up properly to market to the crowd. And so it is an iterative process. Your first crowdfund is always the hardest, especially if you're B2B, because you may not get your message right on day one. And so, that's again, the nice thing about crowdfunding though, is that you're getting instant data. So whether you're running ads, doing social media posts, paying for newsletters, whatever it is, you're going to know pretty quickly what works and what doesn't work. And so you can sort of shift and adjust your message. But again, you also need to be analytical and data driven, because again, you can get the smartest people in the room and think and decide, I think this is how we're going to market our business for crowdfunding. But more often than not, you're not going to be spot on. You're going to have to be able to shift and make changes.
Would you agree with that sentiment, Isaac, that the first crowdfunding raise was the hardest and it got easier and easier from there for subsequent raises, and your messaging has changed and evolved over your raises?
Yeah, I think one of the strongest parts in a tactic and a strategy that I used, and raising capital was informing the public of the progress of the raise. And so I know that you can always go to the StartEngine, page of any crowdfund and look at how much money they've raised in their campaign. But what I wanted to do and what I learned and I was actually taught by Don Dixon, was to gamify that process, because a lot of people are skeptical about whether or not you can raise what you think you're going to raise. So initially I was going to raise $1 million. And so that first, $2,500 looks good on paper, but then let people know when you hit your milestones, because a lot of people will not believe that you're going to actually raise $1 million or how much money you raise. And so as they watch the progress, you may not see them, but they're watching, they're paying attention. So they're like, oh yeah, he's not going to raise $1 million. Wait, he's raised 50K. Uh-oh, he's raised 100K. Wait a minute, he just hit another milestone. He's raised 150,000. That gamifies the process. And then people start getting FOMO. Am I missing out on an amazing opportunity or what? Because all these people are investing, but I'm sitting on the sidelines watching this person continue to raise capital. And so always let people know your progress, because again, people will get FOMO and they will be like, yo, I need to tap in and be part of this. And so always letting people know and gamifying the process is really, really helpful. And I think we do that very well. And I've done that. The first raise was the hardest, because it just, I almost had a panic attack the first time I raised $1 million. When I got to $1 million, I was like, this is a lot of money. But I learned a lot in that process. But it becomes easier and easier because now you understand the process of going through the process of launching a campaign. You know your market, you know your audience, you're getting that data, you know who to tap into, the messaging that you want to relay to inspire and encourage people to be part of whatever you're raising. And so it's hard, but it definitely gets easier, and you learn, the quicker you go.
I want to stay with you for a second, Isaac, and have you talk about how do you manage all these investors that you've acquired over these rounds? I think that's typically a concern we hear from founders who haven't used crowdfunding before. And then Kevin, I'll go to you to talk about the same question, how your clients have managed investors.
Well, for me and our team, we over communicate. So we consistently post updates on the StartEngine campaign. We do 2 updates a week. We send out an investor newsletter. We also do on the app, we have investor audio rooms, because our app has audio chat rooms. So we have these audio town halls to kind of inform people about what's currently going on with the raise and managing. And again, managing a large group of investors. I think we have over 20,000 investors in all of our campaigns combined. It can be hard, but I think all people want to know is they want to have the information. They want to know, what's going on, what's happening, and I think if you're not an effective communicator or not being over communicative to the people that invest your money, and I don't care how small the investment is, $250 is a lot to somebody. So treat them just like someone that gave you $250,000. Just make sure that you're over communicating, you're providing them the information. I always direct them to either StartEngine, what I'm saying, to always tell them, the process in which you can actually see your investment. So I tell people, go in your StartEngine account, look at that. That is your portfolio. That is your wallet. That's where you could always find your shares. If you have any questions, reach out to StartEngine support about those types of things. If you have any questions on our side, reach out to us. So I think over communicating keeps a lot of investors, comfortable. And I think that's the best way to approach it. Because if you just, take somebody's money and then never respond to them or answer any of their questions, because a lot of these people are first-time investors. They've never done this before. They're dipping their toe in the water. And the last thing they want to feel like is that they're ignored or they're getting scammed or anything like that. And so I'm very, very, adamant about over communicating with our community and letting them know exactly what we're doing.
What are your thoughts on investor management strategies for investor management, Kevin?
Yeah, I mean, I think, listen, there's plenty of tools out there where you can sort of communicate with your investors, your community. The biggest thing, again, just agreeing with Isaac, is constant flow of information, be available, keep them updated even when you're not raising money. That's a big one. Don't just go to your community once, when you need their money. be available. I mean, I have a lot of clients who will share, the CEOs will share their personal contact info and say, hey, you know, if you have any questions, let me know. You know, whether it's during a round or outside of a round. I also think just having the CEO be very ever present is important. It's, you know, CEOs have their own full-time job, which is running the company and growing it. Investor relations is crucial. And I think just it's important for the investor community to hear from the CEO. And so whether that's just webinars, I think those are great. I mean, obviously things like this, but specific for a fan base or specific for another client is crucial. You know, these people are putting in, you know, people are putting in $500, $200, $1,000. That's a lot of money for anyone. I mean, I always joke that's a high ticket average order size for an e-commerce play. If I'm buying something online, I'm spending $1,000. That's a loyal customer. So, you know, you have to view your investors as customers too. And you know, it's exciting for, I mean, this is a weird example, but it's not like, you know, if I invest in Apple, I can just get on a webinar with Tim Cook, you know, but that's one of the nice things about crowdfunding is the investor base can connect with the CEO. And yeah, more information, the better.
I'd like to pivot the conversation a little bit and go back to marketing and advertising arrays, specifically around a mix of organic advertising strategies as well as paid advertising strategies that I think, Isaac, you alluded to in one of your comments. Kevin, do you want to speak first just to some of the paid advertising channels, strategies, overall, how does it fit into arrays that your clients have used? And then Isaac, I'll let you speak to how you've sort of expanded your overall marketing strategy to leverage paid advertising more recently.
Yeah, I mean, gosh, I'm constantly evolving my strategy on paid marketing, and it differs for each client. You know, I think going back to my example earlier about B2B businesses, you know, even if you're not a B2B business, even if you're a B2C business, you know, you're explaining when you're trying to pitch someone with crowdfunding, you're explaining you know, what you do, but you're also probably trying to explain your market size, trying to explain maybe, you know, where you think you're going, what your growth strategy is. So even if you're B2C, you're not necessarily like, if I'm trying to sell my product to someone off the street, I'm not telling you the TAM or the growth potential or comps for other companies. So there's a lot of information to explain to people. And so one of the things that I've, you know, it's changed a lot in the last few years, and it's still really big advertising channel are these sort of email newsletters. So your ability to sort of promote your company in, you know, again, whether it's something like Robinhood, they have a newsletter called Snacks. There's Morning Brew. There's 1,000 different newsletters out there. Those do really well with crowdfunding because you have people who are purposely clicking the email and reading it. They're opening an email and they're saying, I'm going to read this. And there's a lot of content in there that's not paid. And so when they see a paid advertisement in there, it'll say sponsored by so-and-so, whoever it is. They've committed to sit down and read. And so I've seen that these newsletters can be very good for advertising because you have the ability. You have a couple sentences, a couple paragraphs to explain what you do. That's compared to Facebook or Google or Instagram, which is also a great channel for marketing, but that's a bit more clickbaity. Like, hey, I'm going to click, and you know, I don't necessarily know where I'm going. I mean, obviously it's an advertisement about the business. So I guess what I'm saying is that there's a lot more channels out there that are allow readers and allow potential investors to really understand the business more. And I think that's important because, you know, going back to the earlier conversation, it's, you know, traditional investors used to say, well, crowdfunding investors, they're not real, they're not sophisticated. No, they're just different. They have a different lens on things. They don't necessarily they're not going to look at a pro forma and say, well, you know, what's your EBITDA margin going to be in 2 years based on this or that? You know, they're looking at it from a different perspective, but they still want to be informed. They still want to know about your business, and they want to know all the, you know, all the pros, the cons, everything. And so, yeah, you know, I guess what I'm saying is that is a very useful advertising channel for issuers. And I think it's good to know because, again, these crowdfunding these crowdfunding investors are making an informed decision. They're not just like, oh, this looks cool, I'm going to invest. They still want to learn about the business and know what they're getting into.
Isaac, interested in your thoughts there. I think maybe specifically to Fanbase, how your advertising strategy has evolved over your raises, and then maybe tying in something else. Have you found at all that when you've focused on advertising your raises to your community, or whether it's through paid channels, has that ever felt like it's cannibalizing your user acquisition for Fanbase and maybe shifted the focus away from your traditional user acquisition advertising?
Well, no, I think it's different. I mean, again, I think probably 90% of the capital we've raised has been organic. When we got into paid advertising, it was definitely expanding our opportunity or to reach different people in a different way, and the messaging behind that. I think one of the things that most, I think equity crowdfund investors or early investors are realizing is that this is an opportunity, in the way that we message, even in our paid marketing, is that, you know, giving the reality that rich people have always had the opportunity to invest in companies that you wish you could, right? That's just, and when you convey that, it's like when you convey the message to someone that, they will show you commercials for sports gambling and tell you to go to Vegas, and they'll tell you to play the lottery, but no one tells you to invest in, in Uber or Lyft. And why not? Why do you not get those calls or those conversations or that information when wealthy people are having that opportunity to do so? And so you have to utilize equity crowdfunding, is that this is the breaking point, the way in, to have the same opportunity that VCs have always had. And so that's always been part even of our messaging. But I think I always say it's very unique to what we do, since I'm a social app. I think that we're also able to leverage the frustrations that current people have with other legacy platforms as they continue to kind of get a little bit more restrictive or unhappy with the way that the companies are run. And so it's always good in those types of messaging and marketing. But even that, in some sense, is a little bit organic. But what I say about that is find the organic piece that works for you, and then pay for that. So find the thing that's working already, and then put a little gasoline on top of that. And so that's what we tend to do, is find the pieces of content. We have a fan base promise, a video that we really just talk about, the nature of the business, our belief, who we are at our core, what we believe in, how we feel about the future of social media and the social economy. And that is probably our best performing piece of content ever. And it's a little announcery, it's not just like, it feels like an ad, but it definitely resonates in the paid sector when we utilize that to promote the platform. And so, you test things. You don't have to throw all your money at one thing. You just test the things that are already working organically, and then test a little bit at a time, and just see how that works, and see what your return on spend is. And then if you find that right recipe, then you can win in that space for a little while. You can't always win. You have to switch up your messaging or switch it up, because you will exhaust through a particular sector or a particular group of people, a demographic, an age group, and then you might have to pivot and start looking at other ways to get other people excited about investing. But for most people that are trying to raise capital, even between the $1 to $5 million range, it's more than enough out there for people to do that.
The question for both of you guys, and maybe taking a step back and looking at the industry and where it sort of fits into the broader capital raising ecosystem, what stage do you think companies should be when they start considering crowdfunding? You talked about you bootstrapped to your MVP, Isaac. Is there a specific stage where crowdfunding makes the most sense? Is it more broadly applicable to different stages of companies in different industries? What are your guys' takes on that? Say you're talking to a founder who's thinking about using this. And Kevin, I'll go to you first.
Yeah, I mean, I think in the past, in the early days of crowdfunding, I would see companies that maybe had a prototype, but very high level, and they were able to raise successfully off of that. I think that's changed. I think You need to have product in market. You don't need to have a lot of revenue. You can have a beta and you know, some users, but you need to be in market, and it needs to work. And again, it doesn't have to quite work perfectly, but it needs to work. And, you know, I think, I mean, Isaac, again, that's what you mentioned a few questions ago, is like the crowdfunding investors, they want to be able to touch and feel what you're doing. Ideally, if it's consumer facing, of course. But I think it's important too, that throughout the process of crowdfunding, you're also showing progress in what you're building. You're almost tying use of proceeds to your, you know, hey, we just raised 100K. We just raised 250. And now we've unlocked this, and we're going to do this, and we're going to move the ball forward on the product. It doesn't have to be mid-round. It could always be, okay, the round is over. Now we're going to go back for a few months, build, do what we said we were going to do, hopefully, and then raise again, saying, hey, look at what we just did with our, you know, the money that we just raised. You've helped us do that. I think that's also a very important consideration.
I saw you nodding along there, Isaac. What are your thoughts?
Well, I think the time that it is to raise capital, and this is just my advice to people that want to raise equity crowdfunding, do not think that you can just walk up to a platform like StartEngine and say, hey, I'm going to raise money. A very small amount of people get approved to actually raise, get approved to even launch a campaign. And then in that process, there's a lot of things that you have to know and you have to do to actually complete that process. And some people don't even make it through that. And so I will use the term, make sure you have your ish together before you even want to start. You have to kind of enter this with an honesty of whether or not you have an idea, but you're ready. So even before I ever thought about StartEngine, I created my company, I created my stock structure, I made sure I had my taxes together. You know, I made sure that all these things made the process a lot easier, because then if you're not ready for that, you're going to run into these hiccups. You're going to run into these roadblocks. It's going to slow down your ability to even launch your campaign. And so there's a lot you need to know and understand about your business. Now, for people that, I always say, for people that need small amounts of money, this is great. Like if you need $150,000 to build your MVP, then yeah, you can get it, you know, like I said, $250 at a time to build something, and treat that as a soft raise, right? A soft raise that you can actually have people come in, and then you can build your product, and then keep people, you know, involved in the process of doing that. Now, like I said, best case scenario is you are able to go to the market with something that's already in the marketplace. When we launched our campaign for Fanbase, that first one, we had over 10,000 users. And we had already had a proof of concept and the things that you can do behind the scenes so that, you know, people can't say no. So always think about this. Enter into a situation of why would a VC or an investor tell you no? How many users do you have? Okay, I've got users. How did you get those users? It was organic. I didn't pay anybody to get them. Already answered the questions, like those frequently fired bullets. Just already put yourself through that process and have the answers to those questions. Because then it makes the process a lot easier and you're a lot more prepared. You know what I'm saying? And I say that all the time. I love the idea of equity crowdfunding for any type of person that wants to raise capital for their business. Because again, banks aren't necessarily giving you loans, and in certain instances, there are biases that are sometimes put against certain groups of people that don't really get the opportunity to raise that capital. And so, to being able to turn to your community and grab capital and build your business in that way is a great thing. But even when you do that, have your stuff together, make people feel confident about who they're investing in, make them feel confident, make sure that you are trustworthy. Because again, it's just like you can't scam your way through this process, right? It doesn't work like that at all. And so you have to enter into it ethically, you know what I'm saying, and ready to really, you know, build the business that you believe in, and bring those people that believe in you along with you.
A few more questions for you guys, and we'll start to wrap things up. I think a really common sort of maybe concern or question we're hearing on the StartEngine side from founders we're speaking with is there's so much volatility and uncertainty in the overall global economy and just macroeconomic concerns. How are you seeing those, Isaac, as a founder, Kevin, with some of the issuers you're working with? How are you seeing that actually play out in terms of investor sentiment and participation in crowdfunding raises specifically? Have you felt a blip? Do you feel like you've had to shift messaging around and maybe tie it to sort of overall market trends that feel a little safer? Kevin, I'd like maybe your thoughts on it first, and then Isaac, I'll go to you.
Yeah, I mean, I certainly have some clients that are like, for example, or work with people in like the manufacturing space or who are making products like physical products. And, you know, obviously with sort of the tariff uncertainty as an example, with that specific, you know, with some of them, we've sort of, you know, had to reemphasize the fact that, hey, this product or products are made in the US, or these products are not subject to tariffs. So that's certainly like having sort of that that like litmus test of like, all right, let's lean in on certain messaging more versus others. Like that's absolutely the case. You know, I would say also educating, you always want to educate your user base or your community, I'm sure your investor base or community about the fact that, hey, like you're investing in this. It's obviously risky, but it's not subject to market fluctuations. There's no price. There's no public price for it. So you're putting your money in, and you know, first of all, you shouldn't expect a return overnight. It's not like you're day trading. This is a private investment that has a, let's just call it 5 to 7 year horizon for something to happen. I think that I've seen a bit of a dip recently, but nothing significant. I think it's nice to see that the people who are putting in capital in the crowdfunding deals almost look at it as a separate bucket of the capital that they have to invest, whether, you know, and so whether these people are putting it into the stock market or putting it into treasury bills or whatever it is, like it's been nice to see that I haven't seen a significant decrease in crowdfunding investments or volume, you know, especially given some of the recent economic uncertainty.
What are you seeing, Isaac?
Yeah, I would agree. Throughout this process, even the transition probably from the last administration to the current administration, we actually saw an uptick, a huge, honestly, a huge uptick. And I think that had a lot to do with, okay, now that things are going to be different, you know, where can we invest? And when the market becomes volatile, that fluctuates day to day, an investment in a privately held company and a seed stage company, those are kind of like locked investments. I tell people all the time, when you're investing in an early stage company like this, you are along for the ride. You know, you're with the company to the moon or the ground, and it's a long process. This isn't something that you know, you're going to put your money in, flip it, and get dividends. It's not that type of situation. These are long-term investments with limited risk because there are not these high minimums like 50,000, 100,000 just to be able to invest. And so I haven't seen that, but I also think it also has to do with the amount that people are investing, because people are going to say, hey, you know, I always say that, again, $250 is a lot of money to some people, but it's also the price that someone might spend on a dinner, right? Or go out shopping on a weekend, and say if one weekend you could take that money and put it and park it somewhere in a company that you think has an opportunity to be something special, and you forget about it primarily, you know what I'm saying, if you do sometimes, and then 5, 6, 7 years from now, you're saying, hey, you know, that company that you were with, you got acquired and went public, and it's your opportunity to kind of cash out and do that. So I haven't seen much change. I actually think that this is a really good opportunity for people to raise capital while people are pulling their money out of these markets that are volatile and can park it somewhere else or do something else with it, that I feel like is a little bit more risk averse from fluctuation, but also just looking to the opportunity to invest in things you may not have seen, especially in the AI space, especially in the AI technology space. I'm pretty sure there's tons of companies that are raising equity crowdfunding that have to do with AI and technology and things like that. And I always say the technology sector is just the fastest way to grow wealth. And so I would love to be able to spread a little bit of capital around some companies that I think might do well in that space, and just see what happens.
Mm.
And I think that's a good way of thinking of things, as opposed to you have no idea what's going to happen from one day to the next, whether it's going to be a tariff increase or some sort of issue, and then the market just goes, everybody gets scared, starts pulling their money out. So I haven't seen much, but I just think it's a lot better option to invest in these companies that have a fixed kind of play and a growth strategy.
I'll share some quick data points that largely supports the sentiment you both communicated. The month of March, Reg CF industry-wide, we saw over $44 million invested. Month of April, we saw close to $42 million. And that's even slightly higher than what we typically see on a month-to-month basis, which could be anywhere in the 30 to 40 million range of capital deployed by investors into Reg CF offerings. So the data supports what you guys are sort of feeling on your side as well. What I want to close with is have both of you comment on any founder thinking about using equity crowdfunding. What's sort of the biggest thing they should know going into it? What's the largest pitfall to potentially avoid? What should you really have confidence in and be prepared to do in order to have a successful crowdfunding raise? And Kevin, would love your thoughts on that first, and then Isaac will end with you.
I think it's I think it goes back to my comment on the storytelling and the messaging. Do as much as you can to make sure you're set up for success on explaining your business proposition, your product to the crowd. You could think that your stuff doesn't stink. You could think you have the greatest product in the world, and you may, but that doesn't mean it's going to translate well to crowdfunding. And so that's making sure that you're really focused on good headline, good tagline about the business, whether it's for your page or for your paid or organic activities. Good imagery, all those things are really important. And I think I've seen a lot of founders fail because, again, they think that they can just take what's in their head, throw words on a paper, and think they're going to succeed on a StartEngine campaign or anywhere. And that's half the battle is making sure that you have the right varnish and the right approach for explaining your business to the crowd. I think that's really important. And then be able to pivot, because again, as I mentioned earlier, you may not hit it right on the nose on day one. So to be able to adjust and shift your story or angle is really important.
And Isaac, you for final thoughts.
Yeah, for me, I've done 4 of these. I tell every founder that the level of commitment that you have to do this is serious. I always say that raising capital is like running for office. It does not stop. It's 24 hours a day, 7 days a week. You have to really lean into that. It doesn't matter how many followers you have. You could have no social media presence or a ton of social media presence. And the reason why I know that is I've actually, I've referred some people to equity crowdfunding before that have way bigger brands than I have, and they weren't able to raise hardly any money. But one of the things that I told them was, you have to treat this like a job. You have to lock in, you have to focus, you have to be committed to the process. And then there's also a way that you present yourself as a founder. And I think this is extremely important. I wear the same clothes every day. I wear a pair of t-shirt and jeans. I let people know where I am at all times. I do not post any of my private life on social media. I see a lot of times founders want to create the vision of success, but that also can backfire to say, well, what are you doing with the money? Why are you on vacation? Why are you doing all these things? It's like, if you're locked in, this is blue collar, raising capital. This is not fly. You're not raising money to look fly at all. You're raising money to fund your business. And so if you don't have that level of commitment, I don't care if you have a 9 to 5, every other time that you're off, you're focused on raising your capital. You can't take your foot off the gas. You can't expect other people to do it for you. You have to stay committed to the process, and you'll find those moments of spikes and virality, and you'll find it along the way. But I think some people think it's just as easy as setting up a campaign and then sharing a link and raising money. And I'm telling you, it's not. I know major corporations that have now dipped into equity crowdfunding and are struggling to raise capital after raising an enormous amount of venture capital. So none of that matters. It's the commitment to the process. It's your understanding of your product. It's how you set yourself up for success, understand what type of securities you're going to offer, whether you're going to do a SAFE, whether you're going to do just straight equity into the company, how you offer that equity, what power and protections do you have? So how do you structure your company with different classes of stock, voting and non-voting, all these things. Don't have a crazy valuation for your company, right? Yeah, I like the fact that StartEngine makes you kind of qualify your valuation with metrics. It's kind of like comps and other things provide a, value per user, stuff like that. All those things are just extremely important. It's very, very serious. And in the beginning, and I'll be the first person to tell you, and I'll say this, when I first started equity crowdfunding, I was not as serious as I needed to be. And I had one conversation with StartEngine. I think I missed a deadline. And the conversation that StartEngine said to me, and I took it and never forgot it, was, we could always have somebody else raise this capital. This is a privilege, right? And you need to treat it as such. And from that moment on, I was so locked in and so focused that I've never forgot that, because this is a privilege. Even though it's an opportunity for you to raise that, everybody doesn't get this opportunity to raise capital for their business. And so take it seriously. And if you have that level of commitment, you will absolutely be successful. If you do not stop, don't give up, stay focused, you will meet your goals and be successful at raising capital.
That's great. Yeah, it's so important. Isaac, Kevin, thank you both very much for your time. I think it's really valuable and important and sort of valued by founders to hear your experience and hear your opinions and thoughts on everything. So thank you both. Thanks everyone for listening. And yeah, appreciate the time, guys.
Thank you.
Yeah, thanks for having us.